Hello and welcome to tradingfloor.com's weekly Asian focus. In this video with Andrew Robinson, market analyst for Saxo Capital Markets in Singapore, he gives insight into whether there are actually real signs of a recovery underway in China, as reflected by manufacturing PMI data. He also shares his thoughts on the likelihood of the Reserve Bank of Australia easing interest rates at its November meeting. Welcome, Andrew.
Hello again.
The official China PMI for October is expected to show that there is some degree of recovery underway in the Chinese manufacturing sector. How can that be, considering all the doom and gloom of late? And do you think that any rebound will actually be sustainable?
Well, yes, we saw the flash estimate from HSBC on their manufacturing PMI earlier this week, and it was better than the previous month, 49.1. The actual official numbers, the forecasts are for it to move back above the 50 mark at 50.2 is the estimate for that one. So it does look as if the markets are thinking that maybe the Chinese economy is turning around. As you say, externally there doesn't seem to be much change, and with Hurricane Sandy affecting the US economy, you have to question whether going forward the demand is going to be there for Chinese goods. But having said that, yes, I think domestically we saw the data for this month slightly better. The industrial production, the retail sales, they were both firmer than expected, and I think it's indicating that maybe it's turning the corner. And there's a suspicion that the destocking that's been happening over the past few months may have come to an end. So that's another positive going forward. So on balance, yes, I think it all boils down to the fact: do you believe that the Chinese economy has bottomed out in Q3 and that Q4 is going to be better? Looking at the absolute data, then maybe it is.
As the health of the Australian economy is highly dependent on the buoyancy of China, any signs of a Chinese recovery would be welcome news for the land down under. And with the Reserve Bank of Australia to hold its last policy meeting for the year next week, have expectations of a rate cut now diminished somewhat?
They have diminished to a slight extent, I would say. At the moment, we're looking at a just over 50% chance of a 25 basis point cut at the beginning of November. At the start of October, we were looking at a 100% chance. So yes, the chances have diminished. I do believe that the RBA will cut 25 basis points. I can't see any issue with giving the local economy a bit of a tickle before Christmas, and I think that's probably what they're thinking. As we've said, that the data in both Australia and China might be bottoming at the moment, so the argument for a rate cut might be diminishing, but I do think they will produce one at this time.
And what about underlying inflation issues in Australia, with September CPI having come in at 2%, which is at the bottom of the RBA's range? Is a rate cut likely, to be perhaps put off, despite what you've just said, until its meeting in February?
Well, I think if you look at the headline numbers, as you say, it was at 2%. But if you look at the trimmed mean average, which is a favoured number that the RBA looks at, that's at 2.4%. So that's almost at the middle of the 2 to 3% range that the RBA has. So under those circumstances, you might argue, yes, well, there's maybe a case for delaying another rate cut just in case. Having said that, as I mentioned, I do think they will still cut.
And the Bank of Japan, it added stimulus to the market this week by increasing its government bond purchase program. Is it possible that the RBA could follow a similar tactic if perhaps the rate cut is off the cards for a while?
I do think that's highly unlikely, to be honest. If we look at the compare and contrast the different economies between Japan and Australia, GDP-wise, Japan has been in negative growth for 3 out of the past 4 years, and in the same period, Australia has been averaging something just above 2%. So economically, it's not really justified. If we look at the actual rates that the central banks have set, in Japan, they can't go any lower, that's 0 to 0.1%, yet in Australia, they're above 3%. So the RBA has more room to move on interest rates rather than considering anything seem like quantitative easing. And then CPI numbers, Japan has been in deflation again for the same number of years as the GDP, and yet Australia has been still having a little bit of an inflation issue, or not an issue, but its inflation is still there. So that argument does fall down on that basis. So on the whole, I think the RBA will simply stick to its rate cutting measures if they deem it necessary, and the quantitative easing is certainly off the cards for them.
Thanks for your insights this week into the Asian region, Andrew.
You're welcome.
See tradingfloor.com for more of what Andrew is writing about on Asia.